These are your top stocks bought by Superinvestors this quarter. So for reference, this is my portfolio. So some of the holdings in here are actually the top most bought stock by Superinvestors this quarter. And I'll be covering some of them in here. So this is actually the top most bought stocks by your Superinvestors. As you can see, you have United Health at the very top, followed by TSMC, followed by Google. So I'll be covering all these three companies as well as some other companies down the list as well. So the first company that I'll be talking about is actually Google. So Google today is up around 3%. It is officially above $200 a share. The company is trading at a 22 times earnings. So for Google, if you were to follow the news cycle over the past few months, previously when the company was depressed in terms of the stock price, everyone was talking about how ChatGPT will take over Google's market share, how ChatGPT will be the death of Google, how Google search is a dying business, yet the company is growing revenue by double digit, how Waymo is losing to Tesla, how Google Cloud is not growing as fast as all the other hyperscalers, and yet Google has executed so well in the process. In reality, the company is executing very well and the numbers are great. So for Google, if you were to look on Twitter as well, there's multiple different bears becoming bullish again. So for example, this is one of the bears on Twitter. So he actually came out and said that Google's golden goose is ill. AI overviews won't be the cure on May the 8th. When Google stock dropped around 7% because of some news related to ChatGPT becoming integrated into Apple's iPhones. And today he actually came out and said that my tune is changing on Google. They're handling AI search well. And I expect another major overhaul next May, one that delivers a unified AI-powered Google experience across a single surface. So previously when the stock was at $160 a share, he was bearish. And now that the stock is above $200 a share again, suddenly Google is an amazing buy. So price follows sentiment. When the price goes down, sentiment goes down. When the price goes up, your sentiments go up. So what you should be doing as an investor is to buy when the sentiments are low. So I don't think Google is a great buy today, but nonetheless, the company is executing very well. It is probably one of the highest quality companies out there to hold. So for Google, if you have to look at the valuation today, the valuation is still reasonable. It is trading at a 22 times earnings, and if you have to normalize it, it's probably around a 23 to 24 times earnings. So the company today is still trading at a depressed valuation as compared to its counterparts. So Meta is trading at a 27 times earnings. Your S&P 500 is trading at a 26 to 27 times earnings as well. So Google is still undervalued in that sense. But for this business, I think it is currently around fair value. So for Google, they have that DOJ lawsuit coming up as well. So in late August, the DOJ lawsuit will have a settlement where the judge will decide what measures to take on Google. So the presiding judge appears to be seeking a middle ground between two extremes, considering a range of options in the area of contracts, divestitures, and data sharing. While the judge has asked provocative questions about divestitures, suggesting it could be a simpler solution, he has suggested that a forced sale of popular products like Chrome would be considered a hard case legally and factually. The judge is cautious about the practicality of finding an acceptable buyer and ensuring continued support for Chromium, the open source web browser platform underpinning Chrome. As an alternative to divestiture, mandatory search engine choice screens are also considered. So the judge is probably in the middle. I don't think Google will be forced to sell Google Chrome, but of course there's the risk when it comes to owning the company as well, which is what you need to measure as an investor. So for Google, the business is strong. The company is executing well in all fronts. Google Cloud is gaining market share from AWS. Search is not going anywhere. Search is still extremely strong in terms of the metrics. And Waymo is a wild card. So for Google today, you're buying a business. You're buying not just Google Search. You're buying all the different other businesses coming together, forming sort of like an ETF. So for Google, I view this as a long-term hold for me. The company is my largest position in my portfolio, and I will continue holding this stock unless something fundamentally changes with the company. The next stock that I'll be covering is United Health. So United Health is the most bought stock by your Superinvestors this quarter. The company is cheap, but people are worried about what is going to happen next quarter. It looks like Amazon in 2022 when the earnings were suppressed. So in 2022, Amazon's earnings actually became negative at one point. The company was losing money, but not because the company was poor. It was because of macroeconomic conditions. So for United Health, it is currently experiencing something similar as well. So the entire healthcare space is undergoing headwinds. Your costs are extremely high right now, and all your healthcare companies have actually underestimated the cost itself, and that's why they're suffering right now. So the earnings for the company is artificially depressed And once the earnings normalize again, you will see United Health growing like its historical averages. So for United Health, the company is suffering now because of your high medical cost ratio, because they prioritize top-line growth rather than protecting the bottom line. So the ex-CEO, Andrew Whitty, he wasn't really an insurance guy. He prioritized a lot of top-line growth. So he wanted a lot of revenue growth for the company. They brought in a lot of people under their insurance plans. And because of that, they failed to price their premiums at an appropriate level. And that's why the company is suffering losses today. So once they adjust their premiums back to account for the increase in cost, their profits will likely recover and rebound. So management actually came out and said that 2026 will be a year where the company experiences moderate growth. So you can expect around a mid to high single digit growth from the company. And beyond that, we expect United Health to go back to its historical profitability and growth. So for United Health, as well as all the other healthcare insurance companies, they're planning to increase the prices of the premiums this year as well as next year. So for your insurance companies and the insurance plans that they sell, they typically last for about a year, so it's short tail insurance. And after that year expires, they can actually increase the premiums on all these different insurance, which is what all these companies are trying to do. So as you can see, 8 of them is actually planning to increase prices by upwards of 30%. And the majority of them is planning to increase prices between 10 and 20%. So next year and over the next few years, you can expect the earnings to recover for all these healthcare insurance companies. So the earnings are suppressed right now. If you have to look at the price to sales ratio for United Health, it is at one of its lowest points over the past 4 decades. So the last time it was this low was in your dot-com bubble, of course. And the other time that it was this low was in your 2008 crisis. And currently is approaching that level as well. So for United Health, I'm measuring it using the price to sales ratio because the company's earnings is suppressed right now. And once it returns back to profitability, once the earnings normalize, then you can expect a lot more earnings growth for this company. The next stock that I'll be covering is Adobe. So Adobe today is around flat. Year to date, the stock is down around 22%. The company is trading at a 21 times earnings. And for Adobe, I think it is a company that is cheap today. And if you have to look at the metrics, the fundamentals, as well as the earnings history for the company is doing very well. So earnings over the past 10 quarters have actually beaten estimates. But of course, Wall Street is punishing this stock because of the risk associated with the company. So one of the major concerns for Adobe is the losing of their market share. So you're seeing Figma coming up, you're seeing Canva coming up as well, which is the platform that I'm using today. And for Adobe, this could be a concern for investors. Although I much prefer Adobe to Figma, I'm a user of Adobe myself. But this could be a concern for Adobe in the very long term. And besides that, you're seeing popularity grow for Figma as well. So Figma is increasingly being adopted by your use. And as time goes by and as professional editors go away, Adobe's market share will actually decline over time if Figma continues to hold this dominance. So for Adobe, it is falling like it's running out of business. The story is dying and investors are hitting out the exit door. But it is a company with elite metrics. So I think for Adobe, it is undervalued today. But for me, I'll be staying out of this company. I think the company's story is not compelling enough. And unless the stock is massively undervalued, then I wouldn't consider adding this to my portfolio today. The next stock that I'll be covering as well is TSMC. So TSMC year to date is up around 19%. It is one of the most important companies in the entire world. It is currently trading at a 25 times earnings. So for TSMC, if you were to look at the multiple of the company itself, the company's multiple is suppressed simply because the company is not located in the US. So if you were to compare it to Nvidia is trading at a 55 times earnings. If you were to compare it to other semiconductor companies, the company is actually trading at a decent discount considering the mode of the company. So for TSMC, the reason I'm not buying into the company is because of the China risk. So when it comes to TSMC and when it comes to your investments, you should try and frame it. So think of it this way. So although there's a 90% chance that TSMC will be a good investment over the next 10 years, 20 years, because it is the most dominant chip company in the entire world, there's a 10% chance that China could invade Taiwan. And when that happens, you will lose 100% of your capital. This is not true for all your different other semiconductor companies. It is also unlikely that you will lose 100% of your capital for all your different other tech companies. But for TSMC, this could be a likely outcome. And although the probability is low, I don't want to expose myself to this probability. So for TSMC, that's why I haven't bought into the company. I view ASML as equal quality or maybe slightly higher quality. And that's why I have a significant portion in ASML. Of course, ASML and all your different other chip companies will be impacted as well if China invades Taiwan, but there is no risk of the company going to zero. Whereas for TSMC, the risk is present. The next stock that I'll be covering as well is Lululemon. So Lululemon year to date is down around 50%. It is currently trading at a 12 times of earnings. So for Lululemon, the top line is actually slowing. So the US foot traffic is declining. The US sales is only growing mid-single digit. And the international expansion is the only story for the company. So if you were to look at the fundamentals itself, 70% is actually made up of US sales, 30% is international sales. So the international sales is growing rapidly, is growing at 20-30%, but the US portion is actually slowing down, and that is why the company is only seeing single-digit revenue growth, which is much lower than its historical averages. So retail businesses are typically avoids, and time is an enemy for poor businesses, like retail for example. I think American Eagles is probably the better investment right now, given the Sydney Sweeney ad and all the buzz around the company. The company's fundamentals will likely be good in the next quarter when they report their earnings. So that one could be an interesting one for you to look at. Other than that, I think retail is an avoid. I think retail altogether is a very poor business to invest in. And that's why I think Lululemon is a company that I would avoid for the long run. But of course, if you're looking for a swing, I think the company is undervalued today. But for me, I don't do all these things, so it's an avoid for me today. Last portion, I'll be covering some questions left in the comments. So the first one, it says thoughts on FICO. So for FICO, if you're to look at Dev Kantasaria's portfolio, he hasn't trimmed much of his position, despite the company going up to around 100 times earnings. So back in around Q2 of 2025, the company reached a valuation of around 92 times earnings, and that was around a 4-pack at that time. And despite that, Dev Kantasaria actually didn't trim his position at all. And this likely means that Dev Kantasaria thinks that the company is one of the highest quality ones out there. And for FICO, I think the sentiments today are very bad. The company is dropping. The company's sentiments are overblown, of course. And for FICO, I expect its earnings to continually compound over the next few years. And if you're to look at the mortgage portion as well as the FHFA, FICO only has around 20-25% of their revenue coming from that portion. The company will still grow in all the other segments, like your auto loans, like your consumer credit. So for FICO, I view the risk today as overblown. The next question is his thoughts on Palo Alto as well as Mercado Libre. So for Palo Alto, it is a cybersecurity company. It is one of the larger ones in terms of cloud security. But for all your different cybersecurity companies, it is extremely fragmented. No one wins in the space. So it's either you buy all of them or you don't buy any of them. So for Palo Alto, CrowdStrike, I view all these companies as extremely overvalued today, and that's why they don't interest me today. But of course, you have the alternative, which is Fortinet today, that looks decently valued. And so for all your cybersecurity companies, I don't think I'll be looking into them anytime soon. As for Mercado Libre, I don't like the fintech portion of the business. It is prone to credit risk. As for the retail segment, you really have to understand the South American economy in order for you to invest into the company. I hope you guys have found this one useful and invest safe.